Good day, everyone, and welcome to today's webinar. My name is Sam Wilson, an ESG Director at Socialsuite. I'll be the host for today's webinar, and I want to thank you all for attending this session. It'd be great if you could kick off some of the action by writing in the comments about where you are on your ESG journey and any questions that you might have on this topic. Maybe it's around your GHG footprint or around your disclosure requirements at this moment. Please feel free to write them in the comments section. ESG Investment Guide, Why Investors Care About Climate. We'll explore why investors place such significant emphasis on environmental, social, and governance factors, particularly in relation to climate change. Today, we are joined by Duncan Paterson, Director of Investor Practice from the Investor Group of Climate Change, and Socialsuite's Chief Impact Officer, Dr. Tim Siegenbeek van Heukelom. They will unpack the top reasons why investors embrace climate disclosures and performances, as well as the implications this has for their portfolio companies and screening of new investment opportunities. By the way of background, Socialsuite is the leading ESG solution provider for micro to mid-cap companies on the ASX. We work with 100 publicly listed companies globally. Most of them are listed on the ASX. Socialsuite takes a practical approach to helping clients get started on their ESG journey and disclose their ESG credentials, which is all underpinned by Socialsuite's 5 Steps to Maturity program. When you sign up to Socialsuite, you will get an access to Socialsuite's ESG platform and one of our dedicated ESG coaches. The reason for our success is that Socialsuite is an affordable and practical tool for even the smallest organizations to get started. Now I'll pass this over to Tim, but please, if you have any questions, please share them in the comment section and we'll address them at the end of the webinar. Over to you.
Wonderful. Thanks, Sam, for the introduction for today's webinar. And Duncan, welcome today. It's great to have you here.
Great to be here. Thanks, Tim.
Thanks, Duncan. What I'd like to do today is spend the next 20-25 minutes going over the following kind of high-level topics. We'll have a short introduction from Duncan on the Investor Group on climate change and really learn a bit more about what it is, but also how that impacts your business. Then we'll move to the main topic there. Why do investors care so much about climate change? We'll try to unpack that a little bit, and where we can, we'll provide some real-world examples to trying to make that like a high-level narrative you often hear about global movements, the landscape. Trying to make that real with some examples. And then bring it back to the big question we often get is, what is the minimum climate action that I need to take right now? What are the expectations? How does that work? And then how do I get started with that? So that's a bit of the flow today. We'll end, like Sam said, with a question and answer session for a few minutes. So I would highly recommend on the right-hand side, you have your comment section there where you can post some questions. So in the chat, put them in there throughout the webinar, and we'll get to that at the end and see if we can answer your questions. So first off, then let's start with the organization that you're working with, Duncan. Can you tell us a little bit around the IGCC? How does it work? Why was it set up? Why are investors coming together on this one particular topic? Why is that so important that all these investors join to discuss that and do a lot of work on that?
Yeah, thanks, Tim. And John's asked a really good question in the chat as well. So I'll answer your question shortly, John. So the Investor Group on Climate Change has been around for around about 15 years. It was initially established by a group of large institutional investors in order to share understanding, learnings, best practice in the area of implementing climate investment strategies and ensuring that their portfolios start to recognize the future carbon constrained economy we're going to be seeing in the next 2 decades. The Investor Group on Climate Change works through 3 main work streams. So we have the work stream that I'm responsible for, which is Investor Practice, which manages the upskilling and working with their members to ensure that they're moving forward on their climate journeys. We have the Corporate Engagement work stream, which is the local representative for Climate Action 100+, and works with investors to engage with some of the larger emitting companies in our economy in terms of driving down emissions and increasing efficiency for the economy. And then we have the policy work stream. And I always like to talk about the policy guys as the rock stars of the organisation. So they're the ones who are taking on that lobbying and communications role with policymakers to ensure that the investor voice is heard at the policy table when regulations are being set around the issue of climate change. John asks a really good question. What's the difference between IGCC and RIA? So RIA is the Responsible Investment Association Australasia. I had the honour of serving on RIA's board for 10 years, and I was their chair for the last 4 of those 10 years. So I'm very familiar with RIA, John. They do fantastic work. RIA is a much more broad-based organisation than IGCC. So one of the real advantages that IGCC brings to this discussion is a laser focus on the topic of climate. RIA is a broader industry body that looks at a broad range of ESG and responsible investment type issues. They have their own working groups on these sorts of topics. They publish a really good report, which I encourage everyone listening to look out for, which is called the Benchmarking Report, which looks at the size of the responsible investment market in the Australian and New Zealand markets. The latest edition of that one is coming out in a few months, so keep an eye out for that one.
Brilliant. Thanks for that overview, and I think that is indeed a really good question and a good differentiation there about what RIA is doing in IGCC. Now, if we look at IGCC and trying to just bring that down to the level of like, what does it mean to a small business in Australia? Like, can you give us a little bit of an overview of if you're running or operating a small business, how does IGCC kind of impact your work, or what is the benefits you get from the work that you're doing?
Yeah. So the first thing to emphasise is that IGCC is an investment member organisation. So we don't have corporate members, and we're very clear about the focus that we have on serving the interests of our investor members. And so what that means is that ultimately the impacts that we have on the business community are indirect. So the sorts of work that we do on the policy front, the sorts of work we do helping investors, is going to come down the chain and impact on smaller companies and influence the way business is being done and where efficiencies lie. Certainly, one of the things that I heard recently, which really struck me, and I think is a really good point to make, is that what we're seeing at the moment is a lot more interest in the measuring of carbon portfolio emissions, not just at that scope 1 and scope 2 level, but also looking down the scope 3 level, which is looking well into a company's supply chain, looking into a company's products and how they're being used. And the point was made to me recently, I think it's a very good one, that SMEs ultimately constitute a really large chunk of that scope 3 emission for the larger listed companies. And I think what that's going to mean is that the smaller companies who are providing the services, who are keeping the lights on, who are producing the resources that go into the supply chains, are going to be benefiting from advances in climate practices to the extent that they're able to transition their own businesses. So that means, on the one hand, more questions will be being asked about how climate risks are being managed at an enterprise level. But on the other hand, there's going to be enormous opportunities as new industries develop and new ways of doing things start to permeate throughout the economy.
And I think that the main thing is, and what you just flagged is, what we really see is a lot of small businesses think that, well, our carbon footprint's pretty small. It's we'll get to that at some point in time. Like when they want to know our footprint, we'll get to that. But we see that the larger companies are increasingly required by their investors, by the capital markets at large, and also by regulation to fully understand their full carbon footprint, so scope 1, 2, and 3. So if you're a small business, your scope 1 and 2 are the larger supply chain that you're in, their scope 3. So they will inevitably at some point ask you, we need to understand your carbon footprint, because you're our scope 3. You're in the remit of what we need to do. So that will come knocking on the door quite soon. In particular, when we'll get to that a bit later in the webinar, when we start talking about regulation and what is potentially on the horizon there. There's one thing I want to pick up here is that we increasingly, like we hear about a just transition. Can you tell us a little bit about what that is and why that's so important?
Yeah, no, that's a critically important part of the equation. So what nobody wants to see is industry shutting down with no planning and no preparation being made for the workforces and the communities where the industries are operating. Certainly our members are very, very committed. The large investors, many of them are industry superannuation funds who actually represent industries and workers in these regional areas. Nobody wants to see industries shutting down and no planning being made for the local businesses and the local communities that are affected. Just transition is a phrase which is used broadly to refer to the process of ensuring that the economic changes that arise as a result of introducing climate-friendly practices across the economy actually take into account the needs of communities and the people working in those communities. So it's a critically important issue for many of our investors. One of the things that I've noticed recently, I don't know how many of your listeners will be familiar with the great work done by Climate Salad, but I think they've released a report fairly recently where they noted that 19% of climate technology startups are actually coming out of regional and rural areas. And this is a really, really important point. Regional economies rely not just on big city headquartered companies. Regional economies rely on local businesses and smaller businesses to drive their prosperity and to provide employment at a local level. And that report from Climate Salad with that figure about the startups is really striking. It demonstrates that the opportunities that are appearing are not just happening in cities. There are opportunities coming out for new and emerging technologies in rural and regional areas.
Great point, and I think what that means really is that climate and climate change to most businesses, it does pose a risk, but there's also a lot of opportunities associated with that. And I think that's something to really keep in mind, that climate brings both risk and opportunity. And we see that sometimes the risk is overshadowing on the opportunity a little bit. So maybe we can dig into that a little bit more, but answering that question, why do investors care about climate change? So what is really some of those, if we unpack that question a bit more, what are the key areas that they're worried about from more of a risk perspective? And I put them here in kind of a yellow color there. And then you also have the other side of the coin is that what are the potential opportunities around climate as well? So we've got a couple of key areas here that you often hear around climate. So what are the most important ones when we first look at the risk side of things that you really need to start thinking about, and why is that risk so imminent from an investment point of view?
Yeah, and I think just stepping back a little bit, I mean, the broad question, why do investors care about climate change? It's very, very straightforward in the answer. It's because it impacts returns. So climate change and the negative consequences that flow from a disorderly transition and from climate scenarios in excess of 2 degrees, very, very significant negative impacts on the potential for investors to generate returns in the longer term for their beneficiaries. That's all that investors are motivated by, their ability to provide returns to the people that they're responsible for looking after the money for. The investment community is made up of a group of very, very hard-headed people who look at the scientific evidence that's on the table and make judgments about the implications for those potential changes we are seeing in climate for their ability to pay out their beneficiaries in the longer term. And we're talking about superannuation funds who have liabilities 10, 20, 30, 40 years in advance. We're not talking about just short-term investors who are looking at 6-month or 12-month horizons. So when you are looking after money that has that long-term horizon, you really do need to start thinking about things like, what are the systematic implications of climate change if we do have a disorderly transition? What are the physical impacts of climate change going to be? we've all seen the bushfires for the last couple of years. We're seeing large chunks of Canada on fire as we speak. These are all the sorts of physical impacts which are going to be arising from climate change. We see the issue of industries coming and going. It's a fairly common thing that's bandied about, but not often thought about. If you look at the constituents and the nature of the companies in an index like the ASX 100 or something like that, and you go back 10, 20, 30, 40, 50 years, and you look at the companies that were around in those days, they're going to be very, very different entities with very, very different businesses. The rate of change and the rate of turnover in industries is only increasing. And so it's essential that investors are preparing and planning for those sorts of changes in the economic makeup. But as it is always the case, with risk comes opportunity. And as we do see a transformation in the economy, we are going to see those companies that are taking early action, those companies that are prepared, those companies that are transitioning, being advantaged. So investors are looking at it from both perspectives, both from a managing risks perspective and also from an identifying opportunities perspective.
That's a really good explanation there. In terms of, like, in particular here, employee well-being and productivity, like some people might say that's a bit of a, in a way, an old one. Like, how does climate impact that? Can you maybe expand a little bit on that?
Yeah, there's plenty of evidence out there that businesses that attract and retain the right kind of talent, the best kind of talent, are those businesses that are aligning their mission, their vision, their interests with those of their employees. And what we are seeing with younger generations is an increased focus on the alignment between the work that they're doing in their day-to-day business and their own personal beliefs. And there is considerable evidence that that younger generations are taking issues such as climate change and other ESG issues very seriously. So those employees who want to attract and retain the best talent are starting to talk about how they're utilizing their positioning on issues like climate change, like the broader ESG issues that you guys work with in their HR and in their recruitment practices. So you're seeing more and more of that.
Yeah, that's a good point. Yeah, thanks. Now, we then move towards like trying to make that a bit real and look at the voluntary reporting, regulation, investor demands. A lot of companies are trying to piece together, what should I be doing? So what's the minimum climate action within the Australian environment that I should take right now? So we got a few things here around the Australian regulation at the moment that are somewhat related to climate there. There's definitely some things around voluntary reporting. So a lot of companies, especially the larger ones, have been doing that for a long time, trying to, on a voluntary basis, explain where they stand from a carbon footprint point of view, from their targets, their goals, scenarios, how do they align with that? But then there's also a component around supply chain requirements that we just flagged a little bit earlier around, maybe you're not your small business and you don't follow any particular regulation at the moment. You're not really doing a lot of voluntary reporting or any of that, but you really increasingly get demands from your supply chain to provide them with climate data, like where do you stand? So if we look at these things here, Duncan, then where would you, there's quite a few things here. Where as a small company would you start? And what is the minimum in, I think, the current environment right now that a small business in Australia would be required, maybe in quotation marks, or what would be the right starting point if you look at these things to get onto that climate journey?
And just to emphasize, I hate the use of the word minimum here, so I'm gonna push back on that. If you aim for the minimum, that's what you'll achieve, right? So I would encourage everybody to have high ambitions in this area. But I mean, certainly in terms of the work that I've done over the years in evaluating companies' ESG performance, because my background is in the ESG research space. What I've found is there's a fairly consistent set of stages that companies progress along as they start to adopt ESG practices of different kinds. so there's 4 broad steps. The first one is developing a statement or a policy or a position at an organisational level on this issue. This could be as much as having a page on the website, getting the board directors around the table to acknowledge that or approach the climate risks that they're going to have to deal with, or think about those things, but have some sort of statement or policy on the table that you can build and work around. The next step then is to introduce practices for managing climate risk. So measuring, implementing changes to systems, things like that within the business. And then, of course, as people say, you can't manage what you can't measure. And so once you've been through that process of gathering data, it could be a carbon footprint, it could be any number of different activities. It could be as much as looking at your power bills and tracking how they go over time. A lot of the time you hear that those sorts of things are also opportunities to step back and generate efficiencies in the business. If energy is one of your major costs, it's one of the major ingredients in climate change. If you can find opportunities to generate efficiencies in that kind of space, then you're onto a winner right from the start. The next step is transparency and reporting. So identifying who the stakeholders are that you want to communicate your progress on climate change to. And then finally, it's the outcomes. So once you've started reporting and keep track of reporting over time, then you're able to demonstrate that the initiatives that you started with a policy and a management system are generating outcomes that can be reported on to stakeholders over time. So that's really, really helpful, I think.
Yeah, I think that's what we see happening, and we kind of, we'll get on the next slide to that. Like, we've tried to map that out a little bit, and what we tend to find is in a lot of companies that we work with is that they, at the moment, are largely driven by an investor-driven demand to understand at first a carbon footprint. So we see a lot of companies starting out with scope 1 and 2, using for instance the greenhouse gas protocol to just get a grip on where they stand. And from there on, there are either supply chain requirements where they need to look at some scoring, provide climate data into their supply chain. And increasingly, I think there is an understanding that regulation is on the horizon there. We've seen a few days ago that the International Sustainability Standards Board has issued their first 2 standards, which are an evolution, so to say, of existing frameworks that have unified. So that's things like SASB, TCFD, CDSB, but also World Economic Forum stakeholder capitalism metrics. They're bringing all that together in a hopefully global, unified reporting framework. And the first 2 standards, the first one is more general, but S2 is really climate-related disclosures. And what we've heard is 2 weeks ago from ASIC as well, the chair Joe Longo said that they're really closely following that and quite interested in that space to see, is that S2 standard, is that going to be adopted globally by a lot of jurisdictions? Is Australia interested in doing the same thing, so that wherever you're reporting in multiple jurisdictions, you're all doing the same thing, you're all at the forefront of reporting the same standardized and comparable climate data. So there's quite a few things happening there, but I think to your point, like if we bring it back to, for a smaller company, to how can you start right now? We've kind of mapped it out a little bit here to create a flow chart there. And I think the main thing is what we see working with a lot of smaller companies in our customer base is that step that you flagged on the number 1, like setting up like a strategy and a plan at a board level, potentially, like how you're going to address this. Is there's still people there that need to overcome some internal climate skepticisms. It's potentially less now, and it's getting less across the board. But do you in your line of work, Duncan, like come across that a lot, the climate skepticism, or is that getting a lot better? And what are some like maybe broad-based hints of or ways of dealing with that?
So I don't, I think reams and reams of articles have been written about how best to deal with the topic of climate skepticism. I think one of the reasons why I was very glad that you invited me onto this webinar, Tim, was that I think and I hope that one of the ingredients in helping people who have questions about the science of climate change and so forth is to demonstrate that the mainstream finance community is taking the issue seriously. It's an issue that has moved beyond Greenpeace or beyond activists on the street waving placards and so forth, and it moved on from that 10, 15 years ago. Investors who have a primary duty to maximize the financial returns to their members under regulation have been taking the issue of climate change very seriously for in excess of a decade and taking action on climate change. Whether they've always done the right thing, whether they've always moved as fast as people would like, generally they're moving at the pace that is most achievable in the context of their fiduciary responsibilities and in the context of their own risk exposures. But I just want to get that message across that this isn't an issue that is being taken lightly. And when you see regulators taking action, when you see the largest businesses taking action, when you see the largest investors taking action, there is less and less room for doubting the science around climate.
Yeah, that's a great point. There are financial implications, and the investors are aware of that. And so the first thing you can do as a small business, well, it's raise the issue at large across the business, and start looking into your own GHG footprint. So we see a lot of companies that are aware of the issue of climate change and aware that investors are interested and actually care about it a lot. But if you ask them, that there's still that point, oh, we'll do it next year or the year after, or we'll wait for regulation. But really and I think that's the point that you flagged earlier. It's not about the minimum action required. It's about be ambitious, but also be ready. It is coming your way. So start looking into it right now and start building your first like corporate inventory. Scope 1, it's not a lot of work. It's just making it a priority. If we follow this flowchart really quickly here, for some larger companies that have particular facilities in Australia that are very high carbon emitters, it's always good to keep an eye on the safeguard mechanism. Important thing for most companies that doesn't really apply. But then going through that, thinking about your climate goals and targets as well. Once you understand your footprint, think about reporting that to any of those voluntary frameworks, which are potentially over not all too long. On the more kind of short to medium term horizon, becoming potentially regulation as well, and then really making sure that you follow what's happening in the regulation kind of landscape, and that you continue to monitor, track, and be able to respond to climate questions, because they inevitably will come up. And it's not a one-off exercise there. It's getting your business in shape that you can continuously start reporting your climate goals, targets, footprint. So there's quite a few things that you can start doing. It's not overly complicated. It's more about making it a priority and just picking one thing to start with. So with an eye on the time, we put a few key takeaways for small businesses on here. And I think that the main ones here is that what we flagged is that it's a material risk to most businesses. Even though you're small, you're not immune from the environment we're operating in. Your supply chain, value chain will ask for it at some point. Everyone, even though you're a small business, you will have a carbon footprint. So start understanding that. See the opportunities as well. And I think I've got your point in there about the regional areas there. It just flags that it's not just a risk. Really kind of start thinking about what are the potential opportunities that I can tap into. And it's a great opportunity to really align with a lot of your stakeholders. So really start building those relationships with your customers, your suppliers, your employees around climate. Listen to them, hear what they're interested in. So some of the key kind of takeaways today. And I want to invite Sam back onto the stage here to just talk a little bit about the questions that come up in the chat there. And I've kept like half an eye on it, but I think there's some really interesting things in there. So Sam, would you want to facilitate the Q&A?
Absolutely. Thanks, guys, for the session so far. It's been really insightful. Now, Bruce and Anna have both asked a question, which I'll summarize into one, which is, do retail, in parentheses, speculative investors care about ESG credentials?
I think it's a great question, and we've been talking a fair bit now about at that high level institutional. I think like what's the movement around more the retail level? Is there an equal amount of interest, or what's happening in that space?
So from our perspective, the bulk of our members are in that institutional space. So, but having said that, we do engage regularly with various players at that smaller end in the retail space. I have name checked Climate Salad, who I know do great work in this place as a network that smaller companies can engage with, smaller investors can access. One of the things that we've done recently is release a guidance document for investors who are looking at investing in private equity. But again, that tends to be larger investors who are looking at that smaller cap space. But in that exercise, there's a really interesting life cycle identified between what they call limited partners, general partners, and then the companies themselves. So you have the limited partners, which are the asset owner or the pension fund who's putting their money into another fund, which is a general partner, which is usually the VC fund. And they're the ones who are then influencing ultimately the companies that they're investing in. And what it just highlights, I think, is that there's an interconnectedness here in the market that smaller companies are wise to start thinking about climate, because when they move from that stage of getting started and move to the point of starting to wanting to access capital, even at that quite small stage, there will still be emerging questions being asked. But yeah, I think probably the best thing at that quite small level is looking at some of the networks which are out there that tailor to those kind of smaller end of the market companies. And Tim, I'm happy to have a chat with you offline about a couple of links we could provide there that might be useful to people.
Yeah, that would be great for the follow. We'll definitely do a follow-up of this webinar to everyone who's attending, and that will include a link to the recording. So answering Grant's question there.
Great. And so following on from Bruce's question, so Bruce is from an ASX listed small cap in the uranium exploration space. Bruce is trying to attract institutional investors who have an ESG focus. Do you have any advice on finding and engaging with ESG investors globally for him?
So I think Bruce was asking about are the institutional and retail investors. So I think the same answer applies. Look at the different networks that are out there. Form a short list of those ones which are going to provide the most value for your attendance, and get along, communicate, network. I think unfortunately, there's no quick and easy way to do this. It's a matter of forming relationships over a period of time, I would have thought.
Great. Before we wrap up, I just want to jump onto our last question that John just posed. To what extent are investors sophisticated enough to focus on the value of carbon? And I think what I've seen happening over the last few years is that in investor forums, and we hear a lot of investors talk about how they look at climate change, at greenhouse gas emissions, is that at the institutional end, they're definitely more sophisticated. While a few years back, you could get away with just publishing your footprint, and that's the end of the story, maybe just even scope 1 and 2. They are really drilling down these days, institutional investors. They asking you to look at really picking apart from your GHG emissions, what are some emissions that we can actually reduce and how? What are some emissions that we can avoid? What are some of these technologies that we can actually bring in to do some work? What are things that are just not economically feasible at the moment, but maybe in a few years? And what are some of the emissions that we'll have regardless? So we actually, at the very end, need to look at offsetting there. So I think the message is that there are quite some sophisticated institutional investors that really want to pick it apart. At the retail level, from what I've seen and hear, is that they really want to see you start that journey. So they might not want to pick everything apart yet, but I think it's a matter of time. But what they want to see is that you actually are addressing it. You have a climate strategy, you have a plan in place to do that, to get to that carbon footprint, to understand where you are, and not stop and not say, well, we know what our footprint is. No, well, how can we do better next year? And out of the scope 3, you got 15 categories in general. Like, a lot of companies start to pick 1 or 2, but over time really start to build that out and start to embed it in your business day-to-day operations. How do you track that? How do you report that? So own your carbon footprint. And I think that's the key message there. So there's still, a bit of a way to go there, but there's definitely, the higher you get in terms of the level of investors, the more sophisticated they are getting, and the more difficult questions they're going to ask you about your carbon footprint and your goals, ambitions, scenarios.
Yeah, and just to add to that, I think what we're seeing is more and more of the educational offerings and the training offerings in the finance and the governance spaces building in whole units around climate and how to manage climate. So CFA, for instance, Certified Financial Analyst courses all make reference to ESG and climate these days. AICD, Australian Institute of Company Directors, runs a very good forum advising directors on how to manage climate risk. That one is coming up in early August, just before our summit at the end of August. So lots and lots of upskilling in parts of the economy which had traditionally not paid a lot of attention to the issue of climate. It's really encouraging.
Thanks, guys. I think that's all the time that we have for today. So I'd like to wrap this up by saying everything that we've discussed today, we're here, Socialsuite's here to help anyone with any questions. Please reach out to us. Our numbers are on the side of the screen. And really to take you on that, to help you begin and to take you all the way on your ESG journey. So thank you to Duncan Paterson for joining us here today. Tim, thank you very much. And I hope everyone has a nice weekend. See you next time.